Big moves incoming for precious metals amid global liquidity increase. Hi everyone and welcome to Ainslie Insights, brought to you by Ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back Drew. He's been looking at global liquidity, which is something we love to talk about here, but many factors going into global liquidity that really make it look like precious metals could continue going. They've been making highs. It's certainly going up already. How are you going today, Drew?
Good, Chris. How are you?
Yeah, good. Look, you've really outlined quite a strong case that we can expect a bullish move coming for gold and silver, and it's really driven by global liquidity and how you talk about how all these things interplay. Talk us through that, some of these macroeconomic indicators you've been looking at that are giving you some idea that really there's some potential here.
Yeah, absolutely. So, gold and silver have more or less been consolidating for about the last 3 months after a strong move up. And recently, they've both broken out of that consolidation. And about a week or two ago, we were talking about how there could be a strong move coming for gold and silver. That move seems to have just started. So, looking at the macro picture, looking at global liquidity, cycle theory, the dollar index, central bank policy, it does look like there are some legs to this move. And Q4 is starting to look incredibly bullish for hard assets, gold and silver specifically. And the few areas that we're looking at were sentiment, the dollar, so intermarket dynamics with the DXY, as well as global liquidity. But specifically to start with global liquidity, we were expecting a bit of an air pocket in Q3. We're nearly done with Q3. And that air pocket worked out with a consolidation phase. So that's extremely bullish. There wasn't much of a pullback, more of a sideways chop during that air pocket. And with liquidity looking quite positive for Q4, it seems like precious metals are really starting to front run, that liquidity and sniff it out early. And you can see that in the miners as well, which are really even front running the precious metals. So gold, silver miners have been performing extremely well for the last couple of months, really saying that smart money anticipates another strong leg up for both gold and silver.
Because it is very interesting when you say the global liquidity, that air pocket that we're expecting in Q3, if that's played out, and the point you're making, the consolidation sideways, there was really no big dip at all. Like it's really just been sideways. That would be a very bullish sign, you would think, if it sort of played out, the down legs played out as not going down, but just sideways and then setting up again for that move higher. Because it hasn't really had the opportunity to unwind some of that sentiment that was originally there over the initial move higher.
Absolutely, very telling when you get these, cyclical consolidation phases. How much of a pullback do you get? And to just have a sideways consolidation into a cycle low is the most bullish possible outcome during this time period. So the macro trend for both gold and silver is looking really strong. From a cycle perspective, you've got the major cycle low in 2022 and the next major cycle low in 2030. So that puts a half cycle low point in 2026, probably mid to late 2026, more specifically. So it's fair to expect a strong move up before that consolidation into the half cycle. So, we're quite far away from that half cycle point now. So this next move up should be quite spectacular because the final move before the consolidation, either into a cycle low or a half cycle low, tends to be almost parabolic. And you can see that with the GSR, the gold to silver ratio, trending down. You can see that with silver really outperforming gold. And the expectation is for this next leg up, silver will outperform gold in percentage terms. But of course, silver is more volatile than gold. So, over a short period, gold is always safer. Over a long period, you know how I feel about silver. It's generationally and centennially undervalued with the GSR of where it is right now. So if you're looking at a 5, 10, 20-year time frame, it's a no-brainer with silver. If you're looking at a 6 to 12-month time frame or a shorter-term trade, both gold and silver are really, really great options at this point.
Look, I know you've brought some charts along. You always love to sort of show us how this stuff is unfolding with those charts. So while you're bringing them up, I'm very curious about that point that you're making of the 2026 timeframe. So you're really saying here, and I think the charts will reinforce this, that we probably get that big move up, potentially a significant move up from here until that point. But we do have to be looking forward. At some point, there will be the time to sort of move out potentially of some of these assets, not necessarily gold and silver, but some other assets, because you are expecting some volatility ahead.
Yeah, absolutely. In terms of the volatility, there is you've got the business cycle, you've got the 4 and 5 year cycles in the S&P, but really the cycle that I pay the most attention to is the 18.6 year land cycle. That's expected to peak between 2024 and 2028 with an average expectation of 2026. Now, because it's the fourth land cycle in a larger 8 year socioeconomic cycle, it will be reasonable to expect a longer than average peak. And early 2026 would mean a lot of the indicators should be flashing right now. And we are keeping an eye on those macro indicators for the peak of the land cycle, but most of them have not really flashed as yet. So there would be volatility leading into that cycle peak. The previous one was the global financial crisis. And like you said, averaging out of those riskier markets into precious metals during this time of volatility makes a lot of sense. It's a slow, long-term process. If you look at the global financial crisis, leading into the peak, you had land falling off first, well before stocks. That's an early indicator. In fact, we can probably pull that up right now, and that's something we've been sort of tracking for a while. But looking at this chart here, what we can see is the land markets in white starting to fall off. This is the peak of just before the global financial crisis, and you see the S&P continuing on. Now, this is where we are today. This is the Trump tariff spill-off. And, the S&P put in new highs. We were very carefully watching the stock markets here for a potential lower high and rollover, but we did break to new highs. And now we're doing the same thing with the land markets. We've had a strong move up with these rate cuts that are back on the table for this month. And, looking forward, we are probably expecting rate cuts to continue on. And land markets have responded quite positively to that. The bond market has reacted in agreement with that. So it's saying that inflation is not a problem and things are looking okay. From that side of things, the Fed does have the room to cut rates. So with the land markets, if they make a new high here, that just shows that there's plenty of runway for that 18.6 year land cycle. That in early 2026 timeframe, which is an average peak, is really not reasonable to expect if the land markets make new highs. And we're not far off at the moment. So all eyes really are on the land markets to get a better idea of where we are in the macro picture. But if the land markets put in a lower high here in white and start rolling over, then we're getting a fairly similar look to what we've seen here, where you've got the lower high and we're rolling over, which shows, look, there's not that much runway left. There's not that much runway left. And an early 2026 peak for this land cycle is now reasonable to expect. And just anecdotally, this is where the Fed cut interest rates in the 26 cycle. So we're getting our first real major cutting cycle starting now. And potentially we're here and potentially we're here. But look, it's nothing's locked in yet. These markets could very easily break to new highs, which means we're not even on the chart here. We're probably somewhere closer to here, which isn't even recorded. So we'll have to see what the land markets are doing. They're looking quite strong at the moment, but that could change very quickly. And in terms of where precious metals fall into all of this, we really want to have a look at how they performed in relation with one another into the global financial crisis. Now, before we do that, let's just quickly zoom into this. This is the land markets today. So you can see this is the previous high, Trump tariff spill, and we're just about getting ready to break the new high. So if this rolls over, we're getting close to that macro cycle peak for the land markets. If this breaks the new high, plenty of runway still to go. So,
and just on that, do you think, like looking at that where it is, that the opportunity to break high is probably there, and probably is that your base case? Because I'm looking at that going, well, that could be the base case here. It might not last that long, but the breaking higher from there would make sense.
Looking at the chart, looking at the fact that it's the fourth land cycle in a 80-year macro cycle, looking at the fact that 2028 is a Shemitah year, which is every 7 years. It's its own 7-year cycle in financial markets that we've been tracking as well. There's a fair amount of cyclical data to suggest that this land cycle will go on for a longer than average peak. And that would mean that 2028 really is that crazy euphoric phase to look out for, as well as a lot of the metrics in terms of the business cycle and inflation. They're not quite there yet in terms of what you'd expect to see at a peak. And bringing it back to that 8-year cycle, which is the fourth land cycle in a bigger 8-year cycle that I mentioned. The previous 8-year cycle peak was the one before the Great Depression. So the Roaring Twenties is what we saw leading into that peak. We're not there
Mm.
yet on
Yep.
any metric. So yes, my base case is that the land cycle breaks to new highs. The land markets break to new highs. The land cycle continues on for a couple of years longer, and really coming out of the 2026 half cycle low for precious metals, which is also a cycle low for Bitcoin and a cycle low for a lot of other commodities, as well as a cycle low for the stock markets. I mean, that's a very powerful point of confluence coming out of the 2026 low. If we see interest rates being cut right now, and the market tolerates a couple of rate cuts because we've got a weak economic landscape with unemployment going up, possibly a deflation shock,
Mm.
and which is not on most people's radar at the moment. Most people are still worried about inflation, but it looks like we might get a short period of deflation. If
Well,
you've got
the data actually supported that, that we
the
saw
first
sort of that
time,
latest PPI. We haven't seen that since the COVID era, really.
exactly right. And so cutting interest rates into a deflationary environment with weak employment could see the market rally for a couple of cuts. You then see a peak. You then see a pull back in most financial assets during the rate cutting cycle. And it's really at the terminal cut and at the point where you can really start with QE again because you've got the correct landscape for it, where you see most markets start to rocket off in a more parabolic way. And I think that was the base case expectation for this cycle because of recency bias with what happened in the C19 era. But if you look at a pullback into that 2026 confluence cycle lows for most assets, and you've got rate cuts at their terminal levels with QE coming in, that's where you really see precious metals, silver, stocks, Bitcoin, everything rocketing up. And that's quite characteristic of the final stage of the land cycle called the winner's curse phase, where no matter who you are and what you've invested in, all the market's doing is going up for a couple of years and everyone feels like a winner. So things like risk management aren't really front of mind anymore. Risk management goes out the window and people get overly leveraged just in time for the cycle to peak, some sort of systemic crash, some sort of systemic meltdown, which could be related to this time the US bond market, the government deficit. And when you get that shake, and especially in the bond market, I mean, it's the foundation of the entire global financial system. So if you get a shake in the foundation of the global financial system, that is the tide going out. And how? And when the tide goes out like that, you see who's swimming naked, and that's when you start to get the real structural instability, which is characteristic of the peak of that land cycle. So just looking at the overall market dynamics and intermarket dynamics at the moment, seeing a land cycle peak right now, which should be worthy of something like not only the GFC, but the Great Depression, isn't there on any metric.
Yep.
Seeing 2028 as a Shemitah year, which is 2 years after the 2026 cycle low, looking at terminal rate cuts, QE, and that confluence, and that parabolic move out of there, all the metrics from sentiment to valuations to cycle time frames, it all adds up for a later than average land cycle. So yes, long story short, I would expect this to break to new highs, but it's a market. There are no guarantees. Anything is on the table at all times. This could very easily roll over from here as well. So while that is my base case, I'm watching it very closely just to get clues as to, maybe the land cycle will top in the next 3 months. But,
Well, at
odds are
least you're going to be able to see it because looking at that chart, it's quite clear that it's heading up at the moment. Like if we saw it rolling over, it's still visual. That's why you keep bringing these up and we keep looking at them.
100%. And, if you look at sentiment as well, the land cycle peak, you really should be seeing that greed, complacency, and over leveraging at that peak.
Right.
And we're just not there yet. If you look at the AAII, which is American Association for Individual Investors, they put out these sentiment readings every now and then. This is a great counter indicator for markets. Something like this at the macro, roughly 20-year land cycle peak should be a lot more bullish than it is right now. You can see a majority are actually bearish. And you've got some neutral and then, some bullish there. But essentially what this is saying is that most market participants have one leg out the door. And, when you're looking for an environment where everyone's has all their chips on the table, everyone is fully over leveraged, this is not the type of sentiment you'd see. So yeah, I don't think from any metric, whether you're looking at the business cycle, sentiment, or valuations or anything, that we are at the land cycle peak. And I'll just quickly share the DXY chart because that's the final piece of this puzzle that's quite important. Leading into that cycle peak, you do see the DXY fall off a cliff, and we have seen a strong down move in the DXY. Now, this chart was done earlier this year when the DXY was still up here. So now it's come down a little bit further, and this helped us form that view that the DXY should fall off. Now, we're somewhere sort of here at the moment. This continued downtrend into that 2027-ish land cycle peak would make a lot of sense. But again, it's just something to keep an eye on. If we've got rate cuts starting now, and we've got a rate cutting cycle coming up into the 2026 cycle low, it would make sense that you've got the DXY falling off as well. I know, we might have a short period of deflation, so you see counter trend rallies along the way, but you've really got a DXY falling off and then falling off further into the peak of that land cycle, and this is where sort of land cycle would probably peak. So yeah, we're just keeping an eye on the land markets and the DXY as we get into rate cuts. I do expect turbulence along the way. I'm fully expecting some sort of peak and correction next year into that 2026 timeframe for the cycle lows. But I think that 2026 is a huge opportunity across precious metals, hard assets, and commodities into that final blow off. However, you got to be really careful not to get greedy and complacent into that final blow off because, like I said, everyone's going to feel like a genius. And that is the time to really be taking chips off the table, averaging into precious metals, securing some of those profits so that you don't just get those profits on paper, but you can actually do something with those profits. And, with precious metals, it doesn't matter which hedge funds are shaking with the US bond market crisis. Doesn't matter which banks are shaking with the bond market crisis. Big institutions will be trembling during this time, and money is only really safe in gold and silver during these macro peaks. So leading into that 2027-ish timeframe, I would be very concerned to have money in banks, hedge funds, super funds, especially if you're close to retirement age. And I'd be looking at securing that wealth with a God-given asset while human systems are crumbling, while we're going from one human system to the other human system, transitioning during a very turbulent, choppy phase. You want a God-given asset that has been around over multiple human systems that will survive these transitions, and then you can re-enter the new human-made system on your own terms.
That makes a lot of sense. Well, one final question to sort of dig a little bit deeper into something you were just talking about with sentiment. It's so interesting when you look at exactly that chart you pulled up that was showing people really are at the moment 1 foot out the door. Why is it that we get to those extremes at the exact wrong time? Is that just human nature playing out? What is it that makes us all think it's going to keep going up right at the point where it's breaking? Is it just psychology? Is there more to it? How do you think about that?
I think it's a combination of factors. Look, there's definitely a strong case for recency bias. I don't know what it is about human psychology, but whether it's that people don't study history or they just refuse to remember it, but the same things happen over and over again, and we just think that what's happened in the last even months, let alone couple of years, is what's going to continue happening. So I think recency bias is a very strong factor. I think greed is another huge factor as well. We're fundamentally wired to be quite greedy, and we're you know with leverage, people they figure out that they've got a lever and they lever it up more and more until the lever breaks. And finally, decisions about buying and selling, about who to vote for, these sorts of decisions are made from the same part of the human brain that control emotions. So you're never going to vote for someone, for example, in an election based on numbers and figures and facts. You're going to vote for someone based on how they make you feel. And you're not going to make investment decisions. Not that you're not going to do it, but more than likely, most people will make investment decisions based on how they feel about an investment or a market or an economy rather than the facts and the numbers. And so because it's emotion driven, when a market's going straight up, it's very emotional. in
Hmm.
terms of greed. And when a market's going straight down, that's very emotional in terms of fear. And it's hard to make logical decisions when we are literally biologically wired to make those decisions emotionally. So I think it's a combination of recency bias and emotion. That's all.
Makes a lot of sense when you put it that way, because it's surely, like, to us when we're looking at these charts and we're looking at this, data in and week out, we think it should be quite straightforward. But nevertheless, we'll still end up in a situation where everyone will get caught out and be, how did this happen to me? Like, how did I not
That's
see it
right.
coming?
That's right. I mean, most market participants won't even have a plan. They'd be making decisions on the go. But the ones even that do have plans quite often get caught up in the emotions and just throw the entire plan out the window. So it's really a question of one, having a plan, and two, sticking to it.
Yeah, very important. Look, thank you as always, Drew. Bringing those charts back, it's always keeping us refreshed, keeping us knowing what's going on, and talking about it specifically today, looking at some of those liquidity aspects and the bigger picture things you're looking at, really valuable for everyone. So thank you for your work on that as always.
Thanks, Chris. Always good to talk to you.
Great to talk to you. Thank you everyone for watching. We'll chat again soon.